Okay, so Bismillah, I think we can begin. So, Assalamu alaikum. My name is Sadiq Mohammed. I am the team manager for ShariaPortfolio Canada. And today's webinar will be on trying to meet the 2023 deadline for contributions to various types of accounts. We're going to look at what those accounts are, inshallah. I do apologize in advance. I've come down with a little bit of a cold, so I have my cup of tea with me if I start coughing, that I ask your indulgence, inshallah. And this is my contact detail on the screen here if anyone would like to get in touch, um, inshallah. Okay, so on today's agenda, what we're going to be going over, number one is an introduction to ShariaPortfolio Canada, its origins, and sort of backstory. We're also going to be looking at investing before the 2023 deadline, which is today's topic of today's webinar. We're going to be looking at what is an RESP, a registered educational savings plan, what is a tax-free savings account, what is a first home savings account, and what these different accounts are and what are the different advantages or disadvantages to each of these accounts. When we're looking at this from a halal or haram perspective, it's important to understand that these accounts themselves are just pots. They're just pots or pans. They themselves are halal as account types. It's what we put in the pot or what we put in the pan that could be halal or haram. And when we look at those ingredients or those different things we can put in the pots or in the pans, there are stocks, there are bonds, mutual funds, ETFs, GICs. There's different types of investments. And we're going to look at these from sort of a Sharia perspective to see what we can and can't do. We're also going to get an introduction to the stock market, what is halal investing, and why it might be a good idea, and also an invitation to visit us at the Reviving the Islamic Spirit conference taking place in Toronto, inshallah. And then we'll try and have some time at the end for some Q&A. So let's go over the who, what, when, where, and why of ShariaPortfolio. So our founder and CEO is Noshad Virji. He has over 15 years of experience. He leads the company's international expansion efforts. He founded ShariaPortfolio in the US and is the CEO of ShariaPortfolio Canada. We also have Sister Sabina Amershi. She's our VP here in Canada. She manages the client service team, marketing, and the advisor team as well. We also have Irfan Chaudhry. He is our Chief Compliance Officer. He's a CFA charter holder. He's a very experienced Chief Compliance Officer. He's had a very, very, very extensive work experience with hedge funds, provincial pension funds, and as well as he was a CCO for a major GCC bank as well in the Middle East. And of course, our portfolio manager, Nadim Mian, who's another CFA charter holder. He has over 16 years of experience in managing investments and a full range of investor needs and situations. He's seen a number of different, market cycles. You can say the bull market, the bear market. He's seen these different markets. So he's a tenured portfolio manager. So what is ShariaPortfolio? So the raison d'etre for ShariaPortfolio is we help Canadian Muslims achieve their financial goals while adhering to their religious principles. This is really why we're here. As the name implies, ShariaPortfolio it's designed to meet with Islamic guidelines, Islamic principles. So as Muslims, we have now in Canada, we now have a dedicated firm, wealth management firm that's dedicated to Sharia compliance. We also act as a discretionary portfolio manager and fiduciary. So ShariaPortfolio Canada acts in a fiduciary capacity, meaning that we act in the best interest of our clients, as opposed to the best interest of the firm or the advisor or anyone else. It's always in the best interest of the client. We can support through our custodian relationship with Fidelity. We can support a plethora of different account types. These range from RSP or locked-in funds, TFSAs, RESPs, the new FHSA account, which we'll talk about in this webinar, individual investment accounts, corporate or institutional. We can support a number of different account types And of course, it's Sharia compliant. So our entire focus is ensuring that the assets under management are managed in a way that is halal and it's conducive with our values as Muslims. So we have a five-step process in wealth management that we adhere to, that we govern ourselves by. Number one is through the relationship building process with our client or our prospect, the individual we're speaking with. We identify clearly what the goals are. We take the time to sit down or to speak with an individual to understand what their time horizon is, what their goals are, what their financial objectives are, so that we can then create a long-term financial roadmap to meet those goals. Right? This is often in the form of an investment policy statement, or a blueprint or a roadmap that explains to the individual, you know, where it is that we can help them to get with regards to their financial management. Step three is really the building out the diversified investment portfolio. And this is done through a number of different strategies and models that we have here at ShariaPortfolio. These range from conservative to moderate to growth up to aggressive. We have passive strategies and active strategies. Again, it's all dependent on what's best for the individual and what's recommended by the portfolio manager. We then address in that plan different wealth management risks and issues. So again, taking the individual's unique circumstances in mind, our portfolio manager will come up with recommendations that really try to address their situation, to build up that roadmap in the best way possible for them. And finally, the fifth phase or step is to monitor and update the plan over time as needed, because as time goes on, our circumstances may change, our situation may change, maybe our risk profile changes over time, so the plan needs to be adjusted. So there's constant communication over the years to ensure that the various life events are taken into account, and we try to plan for those, inshallah. So when we look at the where and when of ShariaPortfolio, ShariaPortfolio US was founded in 2003, so 20 years ago. It is currently headquartered in Orlando, Florida. It's been servicing the Muslim American population or clients for the past 20 years. MashaAllah, has had a great track record of success. ShariaPortfolio Canada has an office in Vancouver and Oakville. It was officially registered in Canada in January of 2020. That's when it became licensed with the Ontario Securities Commission as well as the British Columbia Securities Commission. Subsequent to that, it also became registered with the Securities Commission in Alberta and the Autorité des marchés financiers in Quebec. So it's now licensed as a portfolio manager in 4 provinces in Canada. And as to why, what is the raison d'être, or the reason for ShariaPortfolio Canada, is that our community needs it and demands it. Like, the Muslim population in Canada continues to grow year after year. And the demand for financial products to meet the needs of this growing demographic also continues to grow. So ShariaPortfolio is trying to meet that growing demand, as it's currently Canada's only wealth management firm that is dedicated to Sharia compliance. So now that we've sort of looked at what is ShariaPortfolio, the why, the what, the where, the how, let's look at different account types that a person can have, an individual can have. And we're just going to look at a few in today's session, because we are coming up to the end of 2023. And so we want to be able to address those account types that are about to come due, or about to lapse in terms of the calendar year. So the first we're going to look at is the tax-free savings account. And we're looking at pros and cons of this specific account type. So some of the pros of a TFSA account is that it's a government registered account. It's perfect. It's ideal for long-term savings or specified financial goal. So for example, if you have a goal of, having funds for a vacation, or perhaps saving for a wedding, or perhaps saving for, a major purchase, a TFSA account can be a great way of doing that, because you can take money out of the account at any time. and it's not a taxable event. In fact, growth of the money or the appreciation, if there's appreciation that takes place in your TFSA account, that appreciation, that growth is tax sheltered. So any gains whatsoever in the TFSA are not subject to capital gains tax or income tax. So it's a wonderful account from that perspective. Um, you can take out as much or as little as you want, and there's no taxable event. So it's great for having an emergency fund or a rainy day fund or a, again, special purchase fund that you have for those big purchases or those big expenses. This is a wonderful account for that purpose. The cons are there is a limit to the amount that you can contribute. And therefore there's a limit to what you can do because how much money you have in the account. So if you were 18 years old on December 31st, sorry, 2009, then today's limit would be 88,000 that you can hold in the account. The federal government has been increasing the limit year by year. The 2023 limit increase that we saw was 6,500, which brought it to 88,000. And the government has just announced an increase of $7,000 for 2024. Excuse me. So in 2024, that limit will go up from 88 to 95,000. So the disadvantage to this is there's a limit as to how much you can contribute to your TFSA. Now, if, for example, you turned 18 years old on December 1st, 2023, you're limited to 6,500 because that's how much it was the amount for 2023. The con also is that there's no deduction for taxes for contributing to your TFSA. So, for example, with an RRSP contribution or a FHSA contribution, you receive a tax deduction that you can, a receipt that you can use against your income taxes. So with a TFSA account, there is no such tax deduction available. Excuse me, I'm just trying to stave off the coughing. The second account we're going to look at is an RESP. Now, with a registered educational savings plan, this is a great plan if you are saving for your children's education. So there are certain rules, with these rules come pros and cons for the RESP account. First of all, this is, again, when you're saving for post-secondary education, which depending on the university and the program you're going to, this can be very expensive. It's an excellent way to put aside money for that purpose. And when contributing to an RESP, the RESP is in the mother's or the father's name of the children, and the children are listed as beneficiaries on the RESP account. Contributions made to an RESP are matched by the government up to 20% from the federal government to a maximum of $500 per child per year. So what that means is if an individual were to contribute $2,500 towards their child's RESP, the federal government would top up an additional $500 in that year for that child. This is separate from any provincial top-ups that any provincial governments may have as well. So it's free money. It's a grant. It's an excellent way to get an instant 20% increase on your account. And the funds are necessarily used towards the child's education, paying once a child is old enough to go to a qualifying educational institution, the funds and can demonstrate full-time enrollment in said institution, then the government then the funds can be used for that purpose towards paying the expenses incurred for the education. Another advantage of an RESP is that the growth is tax sheltered. So any gains that take place within the account, there's no tax on those. Okay. So this is it's an excellent dedicated account to fund a very big expense because tuition is not cheap. Where I live in Quebec, which is one of the provinces that has lower tuition costs relative to the rest of Canada. But if you're looking at other provinces or other places, tuition can be very expensive. So this is a really great way to take advantage of government grants or the government contribution and long-term plan your payment of those tuition costs. Some of the costs of an RESP is that, of course, in allocating funds towards this account type, it means that you're not putting funds into an RRSP or a TFSA, so it does cut into those disposable investment funds as well. And if you try to take funds from an RESP other than what it was intended for, meaning to once a child goes to a qualifying educational institution, there are penalties. So in the instance that a person does not go to a qualifying institution and they want to take the money out, for example, a child does not end up going to a qualifying institution, they want to take the money out, the government will then claw back the amounts that they contributed to the account, and there may be other penalties. So the first home savings account, this is the third. Oh, and I should also mention prior to moving on from the RESPs, there is also technically no limit to the amount that you can contribute in any one year. There is a lifetime limit, however, of $50,000 per child. Now, you can absolutely put $50,000 in today to an RESP account. It just means that the total amount that you're going to get from the government is $500. And in subsequent years, you would not be able to contribute more to that account because in order to take advantage of other yearly grants. That's an important consideration when considering contribution amounts to an RESP. This is a new account, the first home savings account. And the deadline for this account is December 31st, just like it is for the RESP account, December 31st. For the TFSA, because it continues to increase in every single year, there is technically no contribution deadline for a TFSA. There's no annual contribution deadline because the amount just carries forward year after year after year. So a person who is 18 years old has never contributed, they can technically drop $88,000 into a TFSA today, and there's no penalty, there's no deadline that was missed. That's not the case, however, for an RESP or an FHSA account, in which case the deadline is December 31st, and you can only carry forward by 1 year. So, for example, for the first home savings account, this is an account where an individual who has not owned with or without a spouse, their principal residence, they could be eligible for this account. And there are certain pros. First of all, contributions to this account are tax deductible, meaning that they do receive a receipt that they can use against their income taxes. And it's pretty much the same as an RSP contribution. So there's a taxable benefit for making contribution to a FHSA account. This account is used towards buying a qualifying home. Qualifying home means that it is a domicile in Canada. So it must be a Canadian domicile. Domicile can mean a house, could mean a condo, it could mean a duplex, or it could be a mobile home as well. That also qualifies per the CRA guidelines. But once a person uses the funds for a qualifying home, that's what the account is for. Gains within the account and withdrawals to buy a first qualifying home are tax-free. So a person can contribute towards their FHSA account to a maximum of $8,000 per year. And again, you can carry forward 1 year only. So for example, if a person was between ages 18 on December 1st of this year, 2023, this is when the account first started, they can put $8,000 into the account today, or they could even carry that forward till next year, in which case they could put $16,000 into it to a maximum of $16,000 in 2024. You must be between the ages of 18 to 71 in order to contribute to an FHSA account. And again, you cannot have previously owned a property, a home, sorry, not a property, a home in Canada. And there is a lifetime contribution limit. of $40,000. So that's the most that a person is allowed to invest into this account. The account also must be used within 15 years of whenever it started. So if a person starts in 2024, they must use the funds before they turn 71 or 15 years from the date the account was open. They don't allow the account to be open longer than that. You can also transfer funds from an RRSP into an FHSA account, and vice versa. You can move funds from an FHSA into an RRSP account. However, these transfers are not considered contributions, so there is no tax receipt for making a transfer. Only contributing new funds into the account qualify for that receipt or that contribution. Transfers between an RSP and an FHSA do not qualify. So this is a really exciting account because, and it just became available on April 1st of 2023 this year, because it does help Muslims or the general population really who are trying to save for a home to be able to put money aside into an account that is registered. So you're getting that taxable benefit, as well as any growth that may occur within the account. So now that we've looked at different account types, and we've looked at the ones especially that have a deadline of December 31st, meaning the RESP account and the FHSA account. So we've looked at the pots, so to speak. Let's look at some of the ingredients now that can go in those pots. And in particular, the most common ones are stocks, bonds, mutual funds, and ETFs. These are the ones that are most prevalent in the market and that most people have heard of. So first of all, what's a bond? A bond is a debt instrument. It's a loan to a company or government that pays back a fixed rate of interest, of return. It is a safer investment than stocks. It's a debt instrument, so there's not a whole lot of volatility relative to public securities or stocks if held to maturity. But it still does have, bonds still do have some risks involved, namely credit risk of the issuer. And from an Islamic perspective, bonds are inherently haram or impermissible because they are debt instruments that carry an interest rate with them. Alternatively, there are sukuk. Sukuk are asset-backed securities. Sukuk is the plural of sak, which means to hit or to strike, as if to strike your name on something. To take a sacred oath, effectively, is the definition of the word sak, which is the singular of sukuk. It's also the origin of both the word and the instrument check. This is ultimately the check was an Islamic invention, or financial mechanism, in which case you would strike a document with your signature, making a sacred oath to meet a financial obligation in the future, which is essentially what a sukuk is. It's an obligation to meet a financial obligation to an investor. So these are structured, sukuk are structured to comply with Sharia law by paying a profit, not interest. So funds are invested and a person receives a partial ownership in underlying asset, whether that's a building or machinery or land, what have you. And that ownership entitles them to a portion of revenue from the profit of that underlying asset. AOFI, which is the governing standard that ShariaPortfolio follows, as well as the gold standard of Sharia compliance in Islamic finance industry, says that defines sukuk as securities of equal denomination representing individual ownership interests in a portfolio of eligible existing or future assets. So it's direct ownership in an asset. So those are two instruments that are fixed income, you can say. Bonds and sukuk, they're both fixed income. One, however, is debt-based, which is not halal. The other is asset-based, which is halal. Now, when we look at funds, what what is a fund? What is a mutual fund? What is an exchange traded fund, or ETF, just for shortened version? A fund is a collection of securities, a basket of securities that trade within one entity. So in a mutual fund, for example, it's made up of a pool of money collected from many investors to invest in securities like stocks, bonds, and other assets. So for a mutual fund, you'll take stocks, you'll take bonds, you'll take whatever assets, and you'll pool them all into the fund, and then individuals will buy the mutual fund. And by buying the mutual fund, you're buying the performance of the underlying assets in the fund. With an exchange traded fund, it's a type of security that involves a collection of securities. So a collection of usually stocks um, that often track an underlying index. In our case, for example, here at ShariaPortfolio, we actually have North America's largest family of ETFs that are Sharia compliant. We currently have 4 ETFs. I encourage you all to look these up because they're all pretty wonderful. There's SPUS, which tracks the Sharia exclusionary index for the S&P 500. There's SPRE, which is a real estate investment trust. There's SPSK, which is an ETF for Sukuk. And there's SPTE, which focuses on technology. So these are our family of ETFs. And each one of these has underlying assets that are compliant with our values. For mutual funds, typically there's active management, right? Usually these mutual fund managers are trying to beat the benchmark, trying to beat the market. Whereas with ETFs, it's passively managed, right? They're just trying to match or keep pace with the benchmark. It's passive management as opposed to active management. With mutual funds, they trade once a day at the end of the day at the net asset value of the fund. So as such, mutual funds are actually less liquid than exchange traded funds, which trades instantly all day. As long as the market's open, ETFs can trade, right? The price can move up and down all day. Mutual funds will report their holdings, the underlying basket of securities. They'll report those holdings quarterly, whereas with an ETF, it's daily. So if the underlying asset allocation in an ETF is changing, it's reported daily. Because mutual funds are more actively managed, there is a higher expense cost. There's a higher management expense ratio than we see with ETFs. They're typically a lower expense ratio. However, some ETFs do offer active fund management. So it's important just to distinguish when you're looking at an ETF, you want to look and see, is this a passively managed ETF or is it an actively managed ETF? Okay, so if we look at stocks, what are stocks? Stocks are ownership in a company. A stock is a legal ownership of a publicly traded company. It's also referred to as a share. The benchmark, so to speak, in the industry is the S&P 500 for stocks. Standard & Poor's list of 500 of the 500 of the largest companies trading in the US. So this is the benchmark, so to speak. And if we look at the performance of the S&P 500 over the past, many years, in this graph we're going back to 1981, for example. We can see that the overall trend is upward. Oftentimes we hear about the stock market going up, we hear about it going down, we hear about it going up. It's a constant moving entity. But the overall trend is upward. And the importance of this graph is really to understand that, because when we look at, the lows that the S&P 500, and this is just one example of one index, right? There's other indexes in the Canadian market that we can look at. There's other exchanges, there's other indices that we can compare to, but relatively they all are bound by this phenomenon that the overall trend tends to be upward. And also that when we're looking at trying to realize gains in the market, when we look at these graphs, for example, we can see that time in the market is more important than timing the market, because a person who realizes some of the downturns in the cycle, if patient, the market tends to recover over time. So staying in the market can often be more important or a better strategy than trying to time those peaks and valleys, the highs and lows. When do we get in? When do we get out? It's oftentimes better to simply just stay in the market and look at the long term in terms of our gains. That's often a better strategy. And of course, it's always best to consult with a licensed portfolio manager in taking any recommendations as to how you should be trading or how you should be doing things. So let's look now at what is halal or Sharia compliant investing. So halal investing refers to investments made in securities which conform to Islamic principles. When these investments adhere to the guidelines of a trustworthy Sharia advisory board, they're considered to be Sharia compliant. So here at ShariaPortfolio, the rule book that we follow is AOFI. AOFI is the accounting and auditing organization of Islamic financial institutions. This is globally regarded as the gold standard in Sharia compliant investing. It's what the majority of Islamic banks globally use for their guidelines. It is an organization that is based in Bahrain. It was established with the purpose of setting Sharia standards for the Islamic financial institutions globally, for the overall industry. So whether it's an Islamic bank or an Islamic finance company or an Islamic investment firm or wealth management firm, AOFI provides guidelines and standards for these various industries or market participants. The Sharia Advisory Board is comprised of these individuals here who are, mashallah, all experts in their field, in this field, and have all studied the fiqh or the jurisprudence of financial transactions in a contemporary application in depth. So when we look at what that means in terms of Sharia compliance and Sharia adherence, we find that there are 4 different guidelines. First of all, of course, we have to remove all companies that are in industries that are participating in activities primarily that are against the Sharia. So in those, we're talking about adult entertainment, tobacco, armaments, financial services, gambling, these types of industries. So we have to remove these companies, and there are others as well. We have to remove these from our stock selection universe. Now, what we're left with are companies that are involved with industries that the Sharia doesn't necessarily have any issue with it. They're permissible. Now, when we're looking at those companies, we have to look very carefully at the financials of these companies to ensure they meet certain criteria. First of all, the source of non-permissible income. And non-permissible income means any income or revenue derived from non-permissible sources. So in this example, we give Walmart as an example on this slide. Walmart sells a lot of different things, but one of those things are weapons. You can buy a handgun or you can buy a weapon at Walmart. But when we look at the amount of sales in weapon sales from Walmart, we find that it's actually much less than 5%. So their sales in weapons do not make them incompatible with the Sharia guidelines. So the sales of the revenue derived from impermissible activities has to be less than 5% of total revenue. Number 2 is that the debt to market cap or the debt to equity ratio should be less than 30%. So what does that mean? If a company, just by numerical or mathematical example, if a company has, say, 10 million shares outstanding and is trading at $1 per share today, so the market cap or the equity of that company is $10 million. If this company has $2.5 million in interest-bearing debt, then that company's debt to equity ratio would be 25%. So according to the AOFI guidelines, this company would be permissible to invest in. But this is something that needs to constantly be monitored, because if, for example, a month or 2 months from now, the share price of this company that has 10 million shares goes from $1 down to 80 cents, well, now the equity is 8 million. And if the debt is still 2.5%, sorry, 2.5 million, this company is now above the 30% threshold. So this company would no longer be considered Sharia compliant. So it's something that does need to be monitored on an ongoing basis. Cash and interest-bearing investments to market cap to equity should be less than 30%. Right? So any investments that the company has made in interest-bearing securities or in addition to cash should be less than 30% of total equity, total value of the company. And finally, liquid assets relative to total assets should be less than 30%. So the company should not be holding more than 30% in cash or cash equivalents to their total market cap. So this is a quote from our portfolio manager, Nadeem. These requirements, these Sharia requirements, inherently require us to buy companies that are not only earning a halal source of income, but also requires us to buy companies that have solid balance sheets with low debt and who make efficient use of their assets. So what our portfolio manager is saying, this is an excellent quote, is that these Sharia screens, they actually help the overall financial performance of the company, because in avoiding companies that are highly leveraged, in avoiding companies that have large amounts of debt, especially interest-bearing debt, by removing those companies from your stock selection universe, you're actually left with stronger performing companies, companies that are in a better financial situation. And especially in a climate like today, where we see interest rates at very high levels, relatively speaking, this puts more of a cash drain on companies that have a lot of leverage versus companies that don't have a lot of debt, interest-bearing debt. They don't have that problem. So, and as something that our founder and CEO, I've often heard him say, Noshad, it's really difficult to go out of business when you don't have debt. So the Sharia screens really do help the overall performance of our stock selection and our models and our ETFs. So that largely concludes the wealth management, or the speaking about the accounts aspect of it. I would like to encourage everyone or anyone who is attending this year's Reviving the Islamic Spirit Conference in Toronto to please swing by at our booth. We'll be there from the conference starts on the 22nd, which is Juma, which is a Friday, ends on the Sunday, the 24th. ShariaPortfolio is a sponsor at this year's event. We'll be there. Please swing by. There will be T-shirts and other giveaways. I think there's some electronics as well that might be given away as well. So please swing by, visit us at the booth, come by, say salam, ask any questions you may have. I'll be there this year along with our portfolio manager Nadeem and one of our other members of staff. So it should be a really great event, and we'd love to see some of you in attendance, inshallah. I'd also like to let you all know that our next webinar will be hosted by our portfolio manager, Nadeem. It will be on the 9th of January, which is a Tuesday at 6 p.m. And it'll be a 2024 investment playbook, a year in review. So please register for this. You look for the registration link, which will be coming out shortly. This will be a great look back on 2023, as well as RPM's outlook for 2024. Highly recommend it. You don't want to miss this. Mark it in your calendars, register, tell your friends, tell your family. You definitely do not want to miss this one, inshallah. So that does conclude the presentation. So Jazakallah khair. What we're going to do now, and these are my coordinates if anyone would like to reach out. And what I'll do now is I'm going to see if we can answer some questions. And I see a question that we have here from Brother Asim. Assalamu alaikum, Asim. The question is, can you contribute into an FHSA under someone else's name? For example, a child, and get the benefits tax deduction in your name. So the answer to that is no. An FHSA account must be under an individual's name who is between the ages of 18 to 71. And spousal contributions are not permitted, unlike with an RRSP, where spousal contributions are permitted. However, under the FHSA account, you must be the contributor to your account. No one else can contribute to your account for you, and you cannot contribute to someone else's account. Again, you have to be 18 as of December, well, as of 1st of April 2023, which is when the account was opened, but also for future years, as of December 1st, you have to be 18 or older in order to open the account, and it has to be under your name. So, but thank you. I think we have another question here, do we? No, we don't. Okay, perfect. I'm just seeing if do we have any other questions? I'll leave it open for a few more minutes, inshallah. I'm just going to post a response, Asim, to your question. Right, and we do have another question coming in from Quasi. Assalamu alaikum, Quasi. He's asking, is there a crypto ETF? So at the moment, there is not a crypto ETF. That is something that is on our radar, though it's something that I think a lot of study is required first before that product is available. Um, we've just launched, just about a week and a half ago or so, we've launched our fourth ETF, which is based on technology. And from the studies that we looked at, we believe that it's going to perform exceedingly well. Inshallah, we pray it's going to exceed. It's going to do very, very well. But at the moment, there is no crypto ETF. But thank you for that question, Quasi. So continue to wait to see if there's any other questions. Okay, so if there are no other questions, I think we can conclude there, inshallah. So, oh, actually, a question just came through. Are the Sharia ETFs, Quasi's asking a follow-up question, are the Sharia ETFs available on the TSX? So these, you can buy these ETFs through a number of different accounts. Like you can, and they are trading, they primarily trade in US exchanges. So they're not trading on the TSX, they're primarily US based. So that's the exchange where they can be found. So I'll just respond to your question here. Yeah, I'll leave it open for a few more minutes to see if there's any other questions, Quasi or others. So Jazakallah khair for everyone who attended today. Please feel free to reach out if you have any questions or you'd like to learn more, inshallah. And please also look for the registration link for our upcoming webinar on the 9th of January from our portfolio manager. That'll be a really important one, the year in review for 2023, as well as a look ahead for 2024. So Jazakallah khair for everyone who attended, and assalamu alaikum.